Good afternoon, ladies and gentlemen. Welcome back to the 3rd of March weekly market review. Today, as usual, I have with me Gerald. How are you, Gerald?
Hi everyone. Good afternoon. We are now into March. Very quickly, the first 2 months of 2025 is over. We are seeing more volatility in the market these days. So hope to be able to share more of these updates with the audience today.
Yes, indeed. Volatility is the key word for the month of February. And last week, we really had a very bruising week on the markets, I would say. We can saw that in the as Nasdaq Composite Index, we were down more than 3%, and for the month, we are down close to 4%. Most of the pullbacks in the US market and some of the counters in Singapore as well was due to Donald Trump implementing his tariffs. So his tariffs now are in full swing. So some of our Singapore counters are also impacted. So I'll let Gerald go through some of the movements in the Singapore markets with you. Over to you, Gerald.
Thanks, Sunny. Okay, before we start the usual disclaimers, today's sharing is for information purpose only and should not be taken to be financial advice. Okay, we have an upcoming SIAS on the 12th of March. So if you have any questions for myself and Sunny, do join the upcoming SIAS session by registering with this QR code. Okay, if you find our weekly market review helpful, do leave us a review on Google. And if you are wanting to join SIAS as a member, you can go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so what did we see for the previous week? The S&P 500 was down by 2.6%, and the Nasdaq was down by a more significant 3.5%. Okay, closer to home, the STI also saw a slight pullback of 0.9%, now back to below the 3,900 levels. So we're trying to understand what is driving this weakness in the markets over the past week. Okay, I think the key is really some weakening in the consumer confidence as well as retail sales that we saw over the month of February. Okay, so if you have been following our weekly market review, over the past few weeks, we have been talking about this weakness in consumer confidence in the US. There was one additional data point that came out last week. This is the Conference Board Consumer Confidence Index. And once again, we see this very sharp fall in the Consumer Confidence Index to below 100 points, represent a very sharp drop from what we saw in December last year. Okay, so that reinforced a lot of the concerns around the high inflation, some of Trump's tariffs, actually leading to weakness in terms of the consumer confidence, like we have seen over the course of February. Okay, on top of that, we saw Nvidia's earnings. The numbers were solid, but they were not a blowout set of numbers. And with that, we have seen a correction in some of the AI-related names because of concerns that maybe the momentum might not be sustained. Okay, so revenue of 39.3 billion for the fourth quarter, that was a 78% increase and a beat compared to the market expectations of 38.15 billion. Earnings per share of 89 cents above the consensus estimate of 85 cents. And they also gave a positive guidance for the first quarter of fiscal 26, revenue of about 43 billion, above the average forecast of 42.3 billion, but below the highest forecast of 48 billion. Okay, so all in beat expectations, but still we see the share price of Nvidia coming down as a reflection that investors are getting concerned about the exposure to these names. Okay, so we see here revenue growing strongly, gross margin remaining high, and then the earnings per share of 89 cents is up 82% compared to the previous year, but still the share price of Nvidia came down. Okay, if I were to look at what is driving the growth in Nvidia's earnings, data center revenue was up by 93%, in the fourth quarter of 2025. So that continues to be very strong. Gaming was down slightly, but the management attributed that to some timing issues, and they expect that to pick up in 2026. Okay, so this is the guidance that we see. Revenue expected to be 43 billion in the first quarter of fiscal year 2026. Like I mentioned earlier, that is above the market expectations, but still not reaching the high end of what the market was expecting. Okay, so then coming closer to home, we saw strong divergence in terms of the share price performance. In terms of the top performers for the STI, ST Engineering gained by 6.3%, Semcom Industries up by 5.9%, and SGX was up by 5.1% after the announcement of the MAS measures to boost the Singapore market. Okay, in terms of top losers, we have got Yangzijiang Shipbuilding down by 26%, impacted by some of the concerns around the US tariffs, and Seatrium down by 11%. Okay, there are two names I want to talk about. The first is OCBC, the last of the banks reporting. Okay, so what we see here, the share price has gone up over the past 1 year, but some slight pullback after the results announcement. Okay, so what do we see here? The net profit of OCBC was up by 4% in the fourth quarter of 2024. The total income grew, but then the expenses of OCBC went up as well. So overall, we saw a slight increase in the net profit of OCBC. Okay, so if I were to look at the net interest margin, it came down to 2.15% in the fourth quarter, and we are seeing consecutive declines in the net interest margin. Okay, so from 2.29% in fourth quarter last year to 2.18% in the third quarter of 2024, and then finally to 2.15% in the fourth quarter of 2024. Okay, if I were to look at the fee income of OCBC, that continued to grow. We saw the net fees and commissions, 517 million in the fourth quarter, an increase from the 460 million in the fourth quarter of 2023. Okay, and if we were to break it down, the growth in the net fee income, a big part driven by the increase in wealth management fee income that reached 246 million in the fourth quarter of 2024. Okay, one point to highlight for OCBC is we saw a very sharp increase in the cost to income ratio as the operating expenses rose sharply. Okay, this was driven largely by staff costs that reached close to 1 billion in the fourth quarter from 870 million in the fourth quarter of 23. Okay, so overall, the cost income ratio of OCBC reached 39.7% in FY24 compared to 38.7% in FY23. Okay, what many investors are keeping a lookout for will be OCBC's dividends. Here we see a final dividend of 41 cents, slight decline from 42 cents in FY23. That is because the company has maintained the full year dividend payout ratio at 50%. Okay, so that's slight decline from the 53% that we saw in FY23. But the company announced a special dividend of 16 cents to bring the total dividend for FY24 to $1.01, representing a total payout ratio of 60%. Okay, in top of that, OCBC announced a 2.5 billion capital distribution over 2 years, including special dividends for FY24 and 25, set at 10% payout ratio of the annual net profit, as well as share buybacks over 2 years. Okay, moving into 2025, they expect the net interest margin to be in the region of about 2%. So that represents a further decline from the net interest margin that we saw in fourth quarter 2024. Cost to income ratio in low 40s. So that is a further increase from the 39.7% that we saw in 2024. And like I mentioned earlier, 60% total dividend payout ratio, plus a share buyback as part of the capital management program. Okay, current valuation of OCBC now at about 10 times PE, one standard deviation above historical average, while the share price is close to an all-time high because the earnings has grown. So that is why the PE is still not at the all-time high level. Okay, price to book ratio of 1.3 times above the historical average of 0.9 times, but that can be partly explained by the higher ROE that the company is making. Okay, next stock I want to talk about is ST Engineering. The share price reached an all-time high last week after the announcement of their full year results. Okay, so overall, we saw strong profit growth for ST Engineering. Revenue for the fourth quarter and full year rising more than 10%, and net profit rising by 20% year on year in the second half of 2024, as well as the full year 2024. Okay, for ST Engineering, there are three key divisions. What we see here, commercial aerospace is now about 40% of the revenue. And if I were to look at the breakdown of the revenue by type, we see that it's still a good distribution between the commercial contracts as well as the defense contracts. Okay, and in terms of the revenue split, about 50% in Asia, 23% in US, and 19% in Europe. Okay, if I were to look at the different divisions across commercial aerospace and defense and public security, we saw very strong revenue growth in the second half of 2024. So commercial aerospace revenue up by 5% in the second half of 2024 to 2.15 billion. And defense and public security up by 20% to 2.6 billion. Okay, so if you're wondering what is driving this improvement in the revenue, for commercial aerospace, we see more maintenance and repair work for the aircraft with the pickup in the global air travel. And then for defense and public security, more spending in defense-related equipment, as well as various public security-linked equipment, which has helped boost the revenue. Okay, we also see an improvement in ST Engineering's order book, now at 28.5 billion, an increase from 27.4 billion in December 2023. Okay, so this order book will be progressively recognized over the next few years, and that will help to drive revenue for ST Engineering. Okay, for ST Engineering, they have also increased their final dividend to 5 cents from 4 cents in the fourth quarter of 2023, and also what they've been paying out previously, which is 4 cents per quarter over the first 3 quarters of 2024. Okay, so with the increase in profit, they have now more confidence towards the company's earnings sustainability and explaining the increase in dividend payout. Okay, so in terms of the valuation for ST Engineering now, it is trading at 18.5 times PE, which is actually still close to the historical average, even though the share price is at an all-time high. That's because the earnings has grown very sharply. Like we saw in 2024, it grew by 20% year on year. Okay, price to book at 6.3 times, which is above the historical average. We see here the consistent increase in ST Engineering's dividend. So in 2019 to 2021, they paid out 15 cents per share. 2022-23, it was at 16 cents per share. And in 2024, with the increase in the final dividend to 5 cents, effectively, we saw a total dividend per share of 17 cents. Okay, currently dividend yield of about 3.7%. which is slightly below the historical average dividend yield of 4%. Okay, so we have come to the end of the earnings season in the Singapore market, as most companies have actually reported. So it's a quieter period in terms of the earnings release. What I'll be keeping a lookout for would be the US employment data this Friday. Given the recent weakness in the consumer spending data, I think investors are keeping a very close lookout for this. And then for investors who are looking at the Singapore savings bonds, we have a new issuance coming up today where applications will open. Okay, so with that, I'll hand over to Sunny for the technical analysis.
Okay, thanks, Gerald, for giving us an update on some of the key movement in the Singapore market stocks, some of them due to some earnings release, and of course, impacted by global events as well. Okay, so yes, so we have rotated back to the beginning of the month again. This is the first week of March, and we are looking forward to the non-farm payroll data, which will be crucial because the recent economic release in the US has been pretty weak and could signal an economic down cycle. So we really need a positive result from the non-farm payroll data to sort of have some kind of continuous rebound in the US market. So you may be asking the US markets or even some of the global Asian markets and Singapore market as well has seen quite a significant pullback in the past 1 week. What is the issue here? Is the economic going to pivot into a down cycle? So I will round it off that there are several issues, double or triple whammy, you would say. Of course, front and center would be Donald Trump tariffs going into full swing, with Canada, Mexico, and China being impacted first. So those, what according to Trump's word, uh, will be impacted first, and he will go ahead with his tariff plans on these three countries. Okay, and then we also have the weak economic data that came out through the whole of last week, which was negative as well, which was not very optimistic. So that added fuel to fire. And then we also saw on Friday that there was a sort of a talk or discussion between Ukraine President Zelensky and Donald Trump, which was caught on camera having a very heated and contentious debate on live TV, which isn't very good for two leaders of the world. Okay, so all this situation actually added a lot of fuel to the negative data and the Trump tariff issues on the market. And also because of that, in the February month, we usually have some kind of a index rebalancing. So that could be the many causes of the index volatility in the past 1 week. And one sort of a significant movement that I saw, especially on last Friday closing, was that you could see that the major US indices actually had a very significant rebound of over 1% towards the very last closing on Friday trading. And it was also reported on the New York Stock Exchange that they observed an unusually huge amount of market on close order, meaning there were institutional reopening their position towards the end of the closing. So that is some of the movement that will be impacted by index rebalancing. And of course, the other sources for Friday big rebound of over 1% on the US indices was because of some of the technical buys, which I will go through now. Okay, so you can see that the Dow Jones index last week we covered the three US indices. We said that the Dow Jones has pulled back quite a bit and will be likely be the first to rebound. So you can see that we tested the 50 days EMA, we tested the 100 days EMA, and we are now holding on to the 100 EMA at 43,285 points. And then that also coincides with the lower bound of Bollinger Band. So these two technical indicators actually attracted technical buyers to come back in to support the Dow Jones index. Okay, so the lower bound of the Bollinger Band is now at 43,215 points. So once the index hit this level on last Thursday and Friday at 43,200 points, you can see that there was quite a bit of rebound on Friday. And the rebound was kept at the blue line again, which is the 50 days EMA, now at 43,838 points. Okay, so I believe that in the near term, the Dow Jones index have bottomed out and we are going back into a range bound formation again, with possibly the support around the 100 days EMA, which is around the 43,200 or 300 level, and with the upper bound of the range bound trading in the next few weeks to be kept at the high that we saw on 31st January, which is around the 45,000 handle. So Dow Jones Index movement likely to move within 43,300 and the 45,000 handle. We also see some positive signs from the indicator. The MACD has shown that the negative reading that we have seen in the past 5 days has been subsiding, and we have a slightly smaller negative reading on Friday, meaning that, hey, the downwards momentum that we have been observing in the past few weeks has not accelerated further and is looking to decelerate and may have a rebound soon, okay? But that also depends on whether we have some confirmation on the other indicator, which is the RSI. The late 47, 48 is very close to the 50-point neutral mark, and we are waiting for that crossover to happen as a confirmation that the uptrend momentum will likely continue, and we want the RSI to be above the 50-point neutral mark, which will also be above the 14 days moving average. That will give technical traders a lot of confidence of getting back into the Dow Jones Index in the short term, okay? So Dow Jones Index near term should have bottomed out at 43,300. We are waiting for some of the indicators to confirm with the RSI above 50, with the MACD to move towards a positive territory, and we could probably see a rebound towards the 45,000 handle in the next few weeks, okay? So that's my take on the Dow Jones Index. Next, let's move to the broader index, which is the S&P 500, which also have sort of created some new all-time high in the previous few weeks, I would say. So it's not a surprise that could contribute to some profit taking that we see in the broad index, and of course, coupled with the reasons that we said earlier, that caused the markets to pull back quite a bit in the month of February, especially in the final week of February, okay? So the S&P 500 actually pulled back towards the 50 days EMA, the blue line, which what we said last week. It's likely to sort of accelerate further downwards, because during the last week period, we don't see any sign that the S&P 500 downtrend momentum will subside anytime soon. And true enough, this week we tested the 100 days EMA, which is the amber line that you see here, at 5,918 points. So we are below the 6,000 handle right now, okay? So where could be the next support level for the S&P 500 index? We will probably be referencing at least the year-to-date low, which happened on 13th of January. So that will be the level that you should be looking at for the next support of the S&P 500 at 5,773 points on the 5,800 level, okay? So the S&P 500 rebounded about 1.6% last Friday, and it's now holding above the 100 days EMA at 5,918 points. And you could see that the next resistance level could be the blue line, which is the 50 days EMA, which was also tested on the 26th of February, but we could not have a breakthrough over there, okay? So we really need some kind of a catalyst again for the S&P 500 to move up. Then that could come in the form of the non-farm payroll on Friday, okay? On the indicator wise, we have seen that the MACD signaling that a smaller negative reading. So the downtrend that we observed in the month of February is starting to subside. So that could signal again to give you a heads up that, hey, the trend that we see in February might be changing, or there could be some kind of mean reversion towards the 20 days moving average at the 6,000 handle again. Okay, RSI is still slightly weaker at 44 points, 6 points below the 50-point neutral mark, and also some gaps away from the 14 days moving average at 50 points as well, okay? So S&P 500 will linger around the 100 EMA for slightly a bit longer before we consolidate further around this level of 5,800, 5,900 level, and then could thereby the range could be between 5,008, 5,009. Okay, I would say 5,900, which is the 100 days EMA, towards the 6,100 level, which is the all-time high that we saw at 6,147 points. Okay, so do be patient there. Market is recovering, and it will take some time for it to recover back to the highs that we've seen in the earlier part of the year. Lastly, the one that retraced the most was the Nasdaq Composite Index. Okay, so the Nasdaq Composite Index actually has a very steep drop of close to 4% in the month of February, It has, of course, last Friday we saw it testing. Last Monday we saw it testing the 50 days exponential moving average EMA in blue. And then, of course, during the week with all the negative news and, of course, the underwhelming Nvidia results, we see that it broke below the 100 days EMA of 19,138 points towards the 200 days moving average. So the 200 days EMA is a very long-term support level to look at, and we are very close to that point at 18,320 points. That explains the big rebound. We have also traded below the lower bound of the Bollinger Band, so that is also another technical buying source that the technical traders look at. Okay, so definitely closer to the 200 days EMA, that you will see traders rushing in to capitalize on this pullback, and they could be trading a mean reversion strategy again towards at least the 20 days moving average at the 19,551 points level before we could sort of get a new all-time high of 20,200 points level that we saw in December last year. Okay, upper bound of the Bollinger Band do give us some space now with some headroom to move to 20,362 points. So indicator-wise, of course, the negative momentum is subsiding as confirmed by the MACD indicator with a smaller negative reading. The RSI, we have also breached, I would say, touched the 30-point level last Thursday. So that means that index could be in a oversold situation, and hence the rebound happened on Friday. So that is a good signal that the Nasdaq Composite Index might have bottomed out as confirmed by the RSI. So the range that we are looking at definitely is using the low bound of the Bollinger Band, 18,739 points. That will be the support level. You could still accumulate around this level. And let's play a mean reversion strategy first towards the 20 days moving average at 19,551 points before we see the moving averages whether it is able to trend upwards again and ride on the rebound for the mean reversion towards the upper bound of the Bollinger Band. Okay, so these are the updates that I have this week. Anything else to add, Gerald?
I think now that we have got Nvidia earnings out of the way, the Singapore earnings season is largely over. Some breather that we have, but do keep a lookout for the US non-farm payroll data because that will give us an indication on the health of the US economy.
Yes, and that data will come in on Friday, and of course, we will update you firsthand on the next weekly market review again, which is on Monday. So do stay tuned to the next weekly market review. And in the meantime, do stay safe and trade safe, and we wish you a happy trading week. Okay, goodbye.